It's my pleasure to introduce Myron Stadnyk, President and CEO of ARC Resources. ARC is focused on conventional oil and gas production in Western Canada. Myron joined ARC in 1997 as the firm's first operations employee and held the position of CEO before subsequently being appointed President and CEO. So with that, Myron, thank you.
Great. Thank you, Will, for the introduction, and welcome to those on the webcast. The safety sign on the back of the room says that the room is capable of holding 797 people. We're not quite full, but I look forward to telling you about all the great things going on at ARC. So starting with our slide, just a corporate profile. Really, I think the way to think about ARC is that in the past 9 years, we've completely transformed the company and have built a modern-day, very focused company, high netbacks on a world-class reservoir being the Montney. We've owned all of our own infrastructure, and we've built our production base up to 600 million a day and 36,000 barrels of liquids. Our only legacy asset is Pembina Cardium, which makes up less than 10% of the portfolio. We have diversified sales into the U.S. and Canada for our products and industry-leading netbacks, all built on the map that you see on the right, which is very focused. This map illustrates our 700,000 acres. We're the third largest landowner in the Montney. We haven't issued any equity for 5 years and have completely transformed the company. What's really important to our business model is paying a dividend. We currently pay 5 cents a month or 60 cents per year. And with our stock at just around $6, it's a 10% yield, so a very favorable yield currently for investors. So how we think about strategy, looking at the next slide, about the quadrants of our strategy, running the business, really think about the profitability of the business, managing a strong balance sheet, which has always been important to us for the 23 years operating the company. A real focus on health and safety. We've now gone over 5 years without a lost time accident for our employees, and I'll touch on that in a bit. The company's built on some of the best assets, lots of strategic optionality in the Montney, and the people, dedicated team at ARC of 475 people, all our field employees and our employees, all our people that operate the wells across Western Canada, as well as our head office staff in Calgary. At the center of the wheel, we think a lot about managing risk as we create value. And through that process, past few years, we've added $1 billion to our cash flow through hedging gains. And over the years, have paid out about $35 of dividends to our shareholders. So we start by looking at profitability. This is our long-term profitability of ARC, and you can see how we've been investing in infrastructure the past couple of years. As that infrastructure comes to payout, you'll see our profitability continue to move upwards. Our past 3-year average return on capital employed is 10%. Now, this slide really describes our priorities in the current year. We're getting a lot of questions around the dividend, so I think this slide does a nice job of showing the reasonable payout ratio of our dividend. If you look at 2018, we cash flowed $820 million, and the dividend payout is $210, so it's about a 25% payout. As we look through 19, we have one flagship project underway called Dawson Number 4, and it's the 4th expansion in our greater Dawson area. How we're managing the funds flow this year, we expect we will pay $200 million out for our dividend. We can sustain our company for $400 million. So if WTI is $50 and NYMEX is $240, we can sustain our dividend payout and our sustaining capital. This year we're choosing to spend to finish Dawson Phase 4, and our company will have grown the past 5 years from 60,000 to 135,000. We'll be bringing that production on in 2020, And so our important theme is that we have a larger company with less capital needs. We've already announced that our 2020 capital will be down substantially from $700 million down to the $550 to $600 million range. So where we're investing this year, our main investment is Dawson, which I've touched on already, and I'll get into the details. We're also incubating Attachie for future developments. We've really cut back on the expenditures there, but we're doing things that are important to advance that project: government approval, testing our type curves, and creating access into that remote area, which has large-scale opportunities for ARC's future. As I talked about in the outset, our balance sheet is very important to us, and we've managed it strictly over our history. And we continue to do so, and as this chart illustrates, against our Canadian and U.S. peers, our debt management's very strong, our balance sheet's very strong. When you look at the resource that backdrops our company, the map on the left illustrates our Montney land position, about 1,000 square miles of land, and you can see the green where the oil and the dry gas in the yellow, and our geological team has positioned us at the intersection of the oil and the gas, so we're advantaged with the opportunity to produce volatile liquids production from massive resources. The center part of this graph illustrates our current reserves at 4 TCF and 200 million barrels of liquids, and then the blue and the green highlights the economic drill locations that have already been highlighted by our independent evaluator. And put that in perspective, we're drilling less than 100 wells this year for a 135,000 BOE company, and the graph highlights the thousands of wells we have on our existing land base. And what contributes substantially to that is the thickness of the reservoir. We've spent a lot of time understanding this, and our reservoir is 1,000 feet thick, so we're able to access multiple layers throughout the Montney. A key focus this year is the lower Montney, which is shown in gray on this picture, and the gray is liquids rich, so we're going to be garnering liquids rich production across our portfolio in the Montney. And our break-evens are very compelling through the Montney. When we look at our break-evens for Tower and Attachie, using $2 AECO gas, our break-evens are below $20 a barrel. And similarly on our gas plays, very, very strong economics. Our one dry gas play we call Sunrise has 75-cent Canadian break-even. The wells are tremendous with about almost 2 million BOEs per well, and which is highlighted on this graph. When our finding costs have been trending lower and lower every year as we learn more and more about the Montney. So we have some of the industry-leading lowest costs of finding resource. Our 3-year finding and development costs have been $5.50, and with acquisitions actually in the $4 range because of divestitures we've made. An important graph on the right highlights our corporate decline rate, which is less than 30%. Why that's important is there's less production to replace every year and allows us to sustain our company for that $400 million that I highlighted on the previous graph. Our product composition is very important in our strong netbacks, and get a lot of questions about NGL pricing, but our dominant liquids are light oil and condensate, which make up 80% of our liquids. Predictable cash flow is very important to us, and the graph on the right highlights the focus that we've have on our crude oil hedges, very strong positions for 2020, and already building the book for 21 and beyond. Similarly, with our natural gas production, we have two important elements. One is to ensure our natural gas is sold to manage the risk across North America. So we're selling about a third of our gas in the Chicago Ventura area, selling gas into Southern Oregon and California, as well as the Toronto Dawn area. as well as Western Canadian production. So we have very long contracts that go well beyond this graph that continue to allow us to access the best pricing across North America and bring that back. And so when you look at the price realizations, you'll see that in, say, for example, Q4 of 2018, where AECO was $1.70, ARC realized $3.47 with our diversification strategies. So we're developing our asset base, doing a great job of marketing, and at the same time managing the ever-increasing obligations around HSE. We've done our corporate responsibility report for over a decade, and our results and our focus have proved very positive. This one graph illustrates how we're increasing production, actually reducing our CO2 emissions, and those are some world-leading numbers. Similarly, our freshwater use has gone down dramatically. We invest in water storage, and we're able to eliminate trucking and pipe all our water to our wells as we fracture stimulate them, and that's substantially reducing the costs of completing our wells by $300,000-$400,000 per well, and also saving the trucking and the emissions and allowing us to recycle water. So lots of positives there. With respect to safety, over 5 years without our employees having a lost time accident, and our recordable incident frequency is world-class, and that competes with some of the best operators in the world. One of the independent groups has stood back and looked at the ratings on environmental performance by country, and then by geographic region and by company, and you can see ARC is noted as one of the top performers in the world for environmental and management and for strong governance. So let's have a look at the infrastructure and where ARC's going. We really believe in owning our infrastructure. Right now is a great example where we're realizing netbacks even though commodity prices are low, because we own the infrastructure and optimize it and are more profitable because of that. This graph illustrates where we're going. We finished building Sunrise Phase 1, so think of our company now as 150,000 BOE. Dawson Phase 4 will be done 9 months from now. We'll be moving to that 160 range, and then we're incubating, doing small activities for Attachie West to create a vision, longer-term vision. And but our company without Attachie will be moving through the 160 into the 170,000 BOE range. Then we'll be able to sustain that company and generate the cash flows to continue to pay our dividends and create an exciting future. So here's a summary of the projects that I discussed. And one really important part of our business model is to think about the profitability of our investments and how efficient our investments are. So this Dawson Phase 4 that I just talked about, starting up in 9 months from now, you can see the couple years of pre-investment necessary to build infrastructure, the blue bars, and then the drilling to fill that up, which will happen early next year. But the punchline is for $290 million, we're building a business that will create opportunity to produce 20,000 BOEs for a decade plus. This whole journey for 10 years is about a $500 million investment to create significant predictable cash flows. And we have many more of these projects to come, and we'll continue to work on that as the future unfolds. So with that, that provides a high-level overview of ARC Resources. And in closing, I think I just illustrated where ARC is differentiating, owning infrastructure, predictable resource. The free cash flow world that every second question is about is something we've designed into the inception of our company in 1996. And this is the reason from $180 million IPO, we've paid out $6.5 billion of dividends in the past 20 years. That's always been in our thinking, and it's nothing new. So we're managing, growing the business and paying the dividend in a profitable way. And by managing that growth in a profitable way, that perpetuates the dividend paying model.